think the gold-silver ratio is a factoid. I think it's important only because the market thinks it's important. Think this through. People say that the ratio should be 16 to 1, which reflects the relative abundance or scarcity of both commodities in the Earth's surface, relative to 100 to 1, which is the price differential. But why should price be a function necessarily of supply or scarcity when it doesn't consider utility and it doesn't consider cost of production? With silver, as an example, about 18% of the world's supply of silver comes from silver mines. The rest comes as a byproduct of mining other metals or as a consequence of recycling. What that means is that the production cost around silver is a minor impact, a minor part of the supply-demand equation. Look, too, at the massive above-ground holdings of silver in private hands. Most of the gold that's held publicly is held in public hands, which is to say in government hands. But silver is controlled in private hands, which makes it much more difficult to measure. In my experience, industrial supply and demand in silver has been interesting, but the quantum moves that we've seen in the silver market, the moves from $4 to $50, or in the 70s from $1.20 to $50, have come as a consequence of overwhelming investment demand. That's happened 3 times in my life. I've seen better than tenfold moves in silver bullion 3 times in my life, and none of them accompanied increases in industrial materials markets. My experience has been that precious metals bull markets are led by gold. Eventually, and we're seeing that right now, leadership changes from the bullion to the highest quality gold stocks. Later, leadership changes to the mid-tier gold stocks. When the momentum in the precious metals markets lends credence to the precious metals narrative, and the generalist investor comes into the precious metals space, perhaps because of silver's lower unit cost, making it more affordable, or perhaps because of its reputation for upside volatility, or perhaps both, the generalist investor, particularly the speculator, becomes attracted to silver. And the leadership in the market changes from gold to silver. Steve, when that happens, you won't need Rick Rule to tell you what's happening. It will be very dramatic. It will be very, very, very apparent. But I'd pay less attention to the gold-silver ratio, and I'd even pay less attention to the utility generated by silver in the industrial market. And I would pay much more attention to the traditional dynamics around investor and speculative demand in precious metals markets and the history of the price action in those markets. Well, I would say that for the Tier 1 boot camp, 100 million ounces of silver probably puts you in strong Tier 2. Okay. Understand that we want minimally $10 million in situ recoverable reserves and resources, but we would prefer $20 billion in situ recoverable reserves and resources. Now, big silver deposits, well, in fact, economic silver deposits are extremely rare. So speculators can be a little more generous in the silver side. We've talked before, you'll remember the silver boot camp, where I think we were able to establish that the market capitalization of legitimate silver juniors is so small that when the generalist investor is tempted down into the silver space, there isn't sufficient market cap to handle the money. These are the most volatile financial instruments in the resource business. If I take myself back to the decade of the 70s, I remember the shares of Coeur d'Alene Mines going from 10 cents to $65. That's not a typo. I was too young, too poor, and too dumb to take advantage of that. But I also remember a wonderful small silver bull market that we had at the beginning of the 1990s. I remember Pan American Silver going from 50 cents, where we had the good fortune to underwrite them, to $45 in 6 or 7 short years. I remember Silver Standard Resources under Bob Quartermain's stewardship. The point of all this is that Cerro de Pasco is part of a fairly small club of legitimate silver juniors with reserves and resources exceeding 100 million ounces, where when the generalist investor comes down into the precious metal space, I should say if, not when, if the generalist investor comes down to the precious metals space, these things can exhibit almost unbelievable upside. The people who buy these things in good markets are not the people who attend the Rule classroom. These are people where if the silver price goes from $30 to $90 or $100, they believe that trend is going to continue on indefinitely. They are people who buy narrative, not fact. You need to be in these markets before they get there. They need to be your exit strategy.
Let me tell you something that may sound a little counterintuitive, maybe even heretical to some of the so-called silver experts out there. I don't believe the gold-silver ratio matters as much as people think it does. Yeah, I said it. I know there's this enduring fascination with the ratio, 16 to 1, 80 to 1, 100 to 1. But I view it as more of a financial factoid than a fundamental. Why? Because the market doesn't price silver based solely on its abundance or scarcity in the Earth's crust. That's geology, not finance. Price reflects perception, investor psychology, market momentum, fear, greed, and yes, sometimes good old-fashioned misinformation. The gold-silver ratio only matters because people think it matters. It becomes self-fulfilling, sort of like astrology with a Bloomberg terminal. Think it through. People love to say, well, there are 16 ounces of silver in the ground for every 1 ounce of gold, so the price ratio should be 16 to 1. Sounds logical on paper. But we don't price things just by their existence. If we did, bottled water would be more expensive than crude oil in Beverly Hills. Let's look at the actual structure of the silver market. Roughly 18% of the world's silver comes from primary silver mines. The rest? It's a byproduct, a derivative. You're mining copper, lead, zinc, or gold, and silver just shows up like that one cousin who wasn't invited to the family barbecue. That means the marginal cost of silver production is dictated more by the economics of those other metals than by the standalone price of silver itself, which of course complicates everything. It also means silver behaves very differently than gold when markets get tight. Most silver isn't produced because of silver demand. It's produced incidentally. So if we have a global economic downturn and base metal mining declines, silver supply contracts whether or not silver demand increases. You get these weird dislocations? That's not something you see as much in the gold space. But here's the real kicker. Silver is held primarily in private hands. That makes it murky, opaque. You can't easily track where the above-ground stockpiles are, who's holding what, or when they're going to sell. That's the opposite of gold, where most of the above-ground supply is tightly held by central banks and governments, entities with a long-term horizon and political motives. Silver, on the other hand, lives in the wild west of retail vaults, industrial supply chains, and shoeboxes under grandma's bed. So when people try to analyze the silver market with the same tools and assumptions they use for gold, it's like trying to play chess with hockey gear. Similar concept, completely different game. Let's get to the meat of it. What actually moves silver in meaningful, explosive ways? Spoiler alert, it's not photovoltaic demand or jewelry trends. It's investment demand, period. I've seen this story unfold not once, not twice, but 3 times in my career. The price of silver moving not 10%, not 50%, but tenfold. From $4 to $50, from $1.20 to $50 in the 1970s, and again in 2011. And each time the catalyst wasn't a surge in solar panel installations, it was a surge in fear, a surge in speculation. That's the nature of silver. It's emotional, it's volatile, it's impulsive. Silver is the drama queen of the metals market. Now here's how it typically goes. Precious metals bull markets start with gold. It's the grown-up in the room. People flee to safety and they buy gold first. The bullion leads. Then, as confidence builds and prices move higher, capital starts flowing into the highest quality gold equities. Companies with low all-in sustaining costs, solid jurisdictional profiles, and proven management teams. Once that stage gets saturated, capital flows into mid-tier names, then speculative juniors. Only then, and I mean only then, does the generalist investor wander in, typically after reading a breathless headline in The Economist or watching a CNBC special called, "Is Silver the New Bitcoin?" At that point, the leadership in the market changes. It moves from gold to silver. Why? A few reasons. First, silver's lower unit cost makes it feel more accessible. It's the poor man's gold, which makes it psychologically attractive to the retail investor. Second, silver's volatility adds rocket fuel to the narrative. When the price starts to run, it really runs. It's not unusual to see daily moves in silver that would take gold a week or a month to match. And finally, it's just fun. People love a good underdog story, but that's also what makes silver dangerous for the undisciplined investor. You can make 10 times or lose 90% in the blink of an eye.
We had a situation in the 1970s that was a very odd recession. It was stagflation, which is to say you had an economic slowdown that was accompanied by inflation too. Normally, recessions are caused by higher interest rates. In this circumstance, the recession was both a cause and an effect of the higher interest rates. That was a really interesting circumstance that I'm afraid we're doomed to repeat. The part of that assertion that I think is particularly relevant to today is that in the decade of the 70s, the absolute purchasing power of the US dollar, which is to say its performance against itself as opposed to some other currency, was that the dollar lost 75% of its purchasing power. It's not coincidental that in that circumstance, the gold price went up. The gold price held or more than held its own purchasing power. If we look back at the decade of the 70s and we put on one side the 75% decline in purchasing power and we put on the other side the 30-fold increase in the gold price, I think we can roughly dissect that. Not exactly. The move from $35 an ounce to say $100 an ounce was mostly a function, I think, of the end of price controls on gold, which is to say it was a coiled spring. When in this country it was at $35 an ounce, there was a gray market for gold internationally between 42 and 45. When the price cap came off in the United States and American demand met world demand, the price went from 35 to 100. The price began to, it is arguable, overshoot in 1974 into early 1975 when the gold price went from $100 an ounce to $200 an ounce. At that point in time, there was broad spread concern about inflation. Everybody wore these whip inflation now badges. Nobody did anything about it, but they wore badges. But Congress did something about it. They raised the interest rate. Well, the market raised the interest rate, and Congress and the Fed followed through. Fairly dramatic increase in the interest rate. That did two things. Well, three things, really. It tanked the bond market. It already hurt equities markets, and it obliterated the gold market. In 1975, the gold price declined from $200 an ounce, to $100 an ounce. Towards the end of 1975, looking at the bond market, looking at the housing market, looking at the equities market, the U.S. government blinked twice and reduced the interest rate. When that happened, investors understood what was happening. The game was on. And the gold price went from $100 an ounce to $850 an ounce in 6 short years. My suspicion is that past is prologue. Now, remember that at $850 an ounce, what you had was a circumstance where gold was overbought. Gold went from being unloved to being the only game in town. So I would suggest to you in the context of today's discussion that the real price of gold in the decade of the 1970s, before the overshoots, probably ran fourfold. In other words, the US dollar declined by 75%, and the nominal price of gold, gold probably mirrored that fall, probably went up fourfold. The move from, say, 400, 450 to 850, I think probably had to do with piling on. I think it had to do with people coming into a trade that had already established itself. We know that mean reversion is usually accompanied by overshoots. And my suspicion is that that happened in the 1970s, and my suspicion is it may happen again.
Here's the thing that nobody tells you until it's too late. In the resource business, and especially in the silver juniors, you don't make money by being right, you make money by being early. That's the only thing that matters. Being early and having the courage to sit tight while everyone else thinks you're crazy. This space, the legitimate silver exploration and development sector, is microscopic. I'm not talking about small cap in the way CNBC talks about small caps. I'm talking about total market capitalization that could be overwhelmed by a single well-funded ETF. If a major institution, say a sovereign wealth fund or even a mid-sized US pension, decided to allocate just 0.1% of their capital to silver juniors, the result would be like trying to shove Niagara Falls through a garden hose. It would break the market. And I don't mean that metaphorically. There is simply not enough float, not enough equity, not enough volume to absorb that kind of demand. That's what creates the parabolic moves in the silver space. That's why you see these juniors go from 30 cents to $10 in a matter of months, not years. That kind of behavior doesn't come from fundamentals. It comes from a liquidity squeeze in a shallow pool. And if you're not already in the pool before the stampede starts, you're not swimming, you're drowning. That brings us to a critically misunderstood point about the nature of these bull markets. They don't evolve gradually. They don't politely announce themselves. They arrive in waves of momentum and mania, usually after years of disregard and disinterest. Look back at 2009 through 2011. Gold moved first. The narrative was all about inflation, post-financial crisis capital flight, and distrust in central banks. Then the gold stocks moved. Quality names like Franco-Nevada, Agnico Eagle, and Royal Gold started to gain serious traction. But silver? It lagged for a while, and then, almost overnight, silver exploded, from $9 to nearly $50 an ounce. That's not a market. That's a riot. Now I hear the same tired objections. But silver has so many industrial uses now. Solar, electronics, medical. Isn't that what's going to drive demand? Look, I love industrial demand. It gives silver a baseline. It smooths out the floor. But that's not what makes silver run. What drives silver parabolic is investment demand, speculative demand, the same type of demand that's driven cryptocurrencies to multi-trillion-dollar valuations with no intrinsic value whatsoever. Silver has something crypto doesn't. 5,000 years of monetary history. Now, is silver going to replace gold? Number. But silver doesn't need to. It's the wild card. It's the leverage play. It's the metal people run to after gold has already moved and the get-rich-quick bug bites the generalist investor. Let me tell you what to look for. Watch for a shift in media tone. When gold breaks another all-time high and the Wall Street Journal publishes 3 editorials in a month asking if the dollar is losing its mojo, that's the beginning. When Bloomberg TV starts inviting precious metals guests again instead of just crypto traders and tech fund managers, you're getting warmer. And when silver breaks out of its consolidation and starts moving up $1 or $2 a week, now you're on the clock. That's the window. Because once retail investors start flooding in, once Robinhood adds another silver ETF to their platform, once TikTok influencers start telling you that JP Morgan is suppressing silver because it vibrates at a frequency that opens interdimensional wormholes, that's when the move is almost over. I say this with 45 years of scars to prove it. Retail is your exit strategy, not your investment thesis. Now let's go even deeper into why this next silver bull market could be even more intense than the ones I've seen in the past. We live in a different world now. The debt loads are astronomical. The US is running trillion-dollar deficits every few months. Not per year, per quarter. The Fed is caught between a rock and a hard place. If they hike rates, they implode the real estate and banking sectors. If they cut, they light a match under inflation. Either way, you're going to see a breakdown in confidence. And confidence is what holds fiat currencies together. Not productivity, not GDP, belief. And belief once shaken is nearly impossible to restore without pain. In that kind of environment, where even US treasuries start to look shaky, where inflation expectations rise and liquidity dries up, people will rush back into precious metals, not for yield, not for capital gains, but for security, for optionality, for insurance. And when that moment comes, and I believe it's coming, the scramble into physical silver and silver equities will be unlike anything we've seen before. Why? Because there's less of it than ever. The largest silver-producing mines in the world are past peak. Mexico's output has declined. Peru's political instability is choking off future investment. And new discoveries? They're rare. The geological model for silver is complex. Unlike gold, which can occur in large disseminated systems, silver is often high-grade but narrow-veined, harder to mine at scale. And here's the other factor that nobody's talking about. ESG mandates. Yes, ESG, environmental, social, and governance frameworks, have made it harder than ever to permit, finance, and operate new silver projects. That means supply is constrained by regulation, even in jurisdictions where geology isn't the problem. That's part of the reason silver juniors are so undervalued. They're unloved, misunderstood, and hamstrung by capital availability. But again, that's exactly what makes them explosive once money starts chasing them. Let's say silver goes from $30 to $100. Most retail investors will look at that and think, well, I missed it. But if you're holding a junior miner that goes from 30 cents to $15, now we're talking life-changing gains. That's what happened with Coeur d'Alene, Pan American, Silver Standard, and countless others in previous bull cycles. But to benefit from that, you need to be positioned now, not later. This is what I call narrative arbitrage. You buy when the story is boring, the headlines are negative, and the market cap is insultingly small. And then, if and when the narrative flips, you become the liquidity the crowd is chasing. You don't need to own dozens of names. You need to own the right ones. Look for 100 million ounces of silver in the ground. Look for management teams that have done it before, not storytellers but builders. Look for tight share structures, low G&A, jurisdictional safety, and real catalysts. But above all, look for companies that are still under the radar, that haven't been pumped by newsletter writers or Reddit influencers yet. Because once the story gets out, the easy money is already gone. And one more thing. I want to emphasize this. You don't need to be a mining expert to succeed in this market. You just need to know human behavior. We are hardwired to chase what's already moving. That's what makes silver's upside so spectacular and so short-lived. Because the same volatility that takes a stock up 10 times in a year can take it down 90% in 6 months when the cycle turns. That's why discipline matters. That's why having an exit strategy is just as important as an entry strategy. If you're going to speculate, do it intelligently. Build your positions when nobody cares. Sell when everybody suddenly does. That's how the real money's made in silver. To close this out, let me quote something I once heard from a brilliant fund manager. If your silver stock goes up 1,000% and you don't sell, it's just another round trip on the crazy train. Remember that, because this sector, more than any other, rewards discipline, humility, and contrarianism. Not hot takes, not memes, not hype. The future of silver is volatile, it's uncertain, but it's also, for those who understand it, extraordinarily bright. Get in before the narrative catches fire, and when it does, let the crowd chase your exits.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.